There is a clear pattern in every financial crisis of the last 100 years. The Great Depression that destroyed 89% of stock wealth, the stagflation of the 1970s that gutted bonds and savings, the 2008 financial crisis that swept away 10 trillion, the COVID crash that fell 35% in 3 weeks, the 2022 bear market that crushed growth stocks by 70%, 5 completely different crises: depression, inflation, financial collapse, pandemic, rate shock, and yet 3 positions survived all of them. Not 4 positions, not 10 different strategies. 3, the same 3 that worked in 1929, worked in 1973, worked in 2008, worked in 2020, worked in 2022. Warren Buffett has 30% of the Berkshire Hathaway portfolio in position 1. Right now, global central banks are buying position 2 at the fastest rate in 70 years. And despite every crisis, every crash, every panic, position 3 delivered 10% annual returns for a century straight. These are not complex strategies. They are not exotic instruments. There are 3 positions that anyone can hold, but most people do not hold them. They chase returns. They buy what is hot. They panic in crashes, and they lose everything because they do not understand the pattern. The pattern that says regardless of which crisis comes, depression or inflation, crash or pandemic, war or peace, 3 positions survive. They preserve wealth. They compound interest over time. And they position you to buy when everyone else is forced to sell. Let me show you exactly what these 3 positions are, how they performed in 5 completely different crises, and why now, in 2025, the smartest investors in the world are positioned in these exact 3 asset classes. Because understanding this pattern gives you something most investors never have: certainty. Not certainty about which crisis comes next. Certainty that whatever crisis comes, you will survive it. Before I show you the 3 positions, you need to understand why 3 specifically. Why not 1 safe position? Why not 10 different positions for each scenario? Because financial markets have 3 fundamental states, and each of the 3 positions solves one of these states. State 1 is deflation or crisis. Asset prices are falling. Cash is king. You need liquidity to survive and capital to allocate at the bottom. State 2 is inflation or currency devaluation. Paper assets lose purchasing power. You need real assets that cannot be printed or devalued. State 3 is growth or recovery. The economy expands. Productive assets compound interest. You need ownership in businesses that generate real profits. Every crisis in history falls into one of these 3 states or transitions between them. The Great Depression was State 1, deflationary collapse. The 1970s was State 2, inflationary destruction. 2008 started as State 1, then turned into State 2 when the Fed printed. COVID was State 1 for 3 weeks, then State 2 when the stimulus hit. 2022 was a transition from State 2 back to State 1. If you hold all 3 positions, you are protected regardless of which state we are in or to which state we transition. Position 1 protects you in deflation. Position 2 protects you in inflation. Position 3 captures growth over time. Together they create what Ray Dalio calls an all-weather portfolio, not because it performs best in every environment, but because it survives every environment, and survival is what matters, because the investors who survive crashes are the investors who have capital to allocate at the bottom. And buying at the bottom, that is where generational wealth is created, but you can only buy at the bottom if you survive the crash. The 3 positions guarantee survival. Let me show you how they worked through 5 completely different crises. The Great Depression, 1929 to 1939. This is the ultimate deflationary collapse, the worst economic disaster in modern history. Let us see how the 3 positions performed. Position 1, cash and treasury bonds. In 1929, cash was backed by gold. The dollar was fixed at 20.67 per ounce of gold when the market crashed in October 1929. Stocks fell 89% from peak to trough until 1932. But cash did not fall. $1 in 1929 was worth more in 1932 because prices were falling. Deflation meant that cash gained purchasing power. Investors who held cash survived. They watched stock prices collapse. They watched real estate prices fall 50% and they waited. Then in 1932 and 1933, when stocks were trading for less than the cash on corporate balance sheets, when entire buildings were being sold for the price of their lobbies, the cash owners bought everything for a steal. Bernard Baruch held cash during the crash. He allocated it in 1932 and 1933. By 1936, he was richer than before the crash. Treasury bonds, short-term government debt, performed even better. They paid 3 to 4% interest while prices fell 25%, real returns of 28 to 30%. Cash and T-bills were the ultimate deflationary hedge. Position 2, gold. Gold was fixed at 20.67 per ounce until 1934. So holding gold meant your wealth was preserved. But here is where gold became extraordinary. In 1934, Franklin Roosevelt devalued the dollar. He revalued gold from $20.67 to $35 per ounce. Overnight, anyone holding gold saw a 69% gain in dollar terms. Their gold did not change, but the dollar price of gold changed. This is why gold survives crisis. Governments cannot devalue gold. They can only devalue their currencies relative to gold. Investors who held gold during the Depression preserved wealth during the crash and gained wealth during the devaluation. Position 3, the S&P 500 or equivalents. This is the controversial one because the S&P fell 89%. How did it survive? Time horizon. If you bought the S&P in 1929 at the peak and held through the crash, by 1945 you were break even with reinvested dividends. By 1950 you doubled your money. By 1960 you quintupled. The Depression lasted 10 years, but the recovery lasted 30. The investors who held the S&P through the Depression and into the recovery created generational wealth, not by timing the bottom, but by owning American businesses for the long term. 3 positions. Cash preserved capital and allowed buying at the bottom. Gold preserved wealth and gained during devaluation. The S&P compounded interest for those who held through the recovery. Together, these 3 positions allowed survival and prosperity through the worst crisis in history. The 1970s, stagflation, 1973 to 1982. This was the opposite of the Depression. Not deflation, inflation, not falling prices, rising prices. This is where most traditional portfolios died. Let us see how the 3 positions performed. Position 1, cash and treasury bonds. During the 1970s, cash was a loser in nominal terms because inflation was 7 to 13% annually. But treasury bonds adjusted. T-bill rates rose to match inflation, eventually hitting 15% in 1981. If you held short-term T-bills and kept rolling them over, you broke even with inflation. You did not get rich, but you were not destroyed as long bond owners were. Long-term bonds fell 50% in real terms during the 1970s because they paid 3 to 5% while inflation was 10%. But T-bills kept adjusting upwards, preserving capital. Position 2, gold. This is where gold proved its inflation hedge. Gold started the 1970s at $35 per ounce. When Nixon closed the gold window in 1971, gold started to rise. By 1974, gold was at $200. By 1978, $300. In January 1980, $850 per ounce, a 24x gain in a decade. Anyone who held 10% of their portfolio in gold saw that position grow to 50% of the portfolio by 1980. Gold not only preserved wealth during inflation, it multiplied wealth. This is why position 2 exists. When governments print money, when inflation runs hot, gold is the ultimate store of value. Position And 3. The S&P 500. Stocks suffered during the 1970s in real terms. The S&P went nowhere from 1968 to 1982, 14 years of flat performance, but with reinvested dividends, you still made 5 to 6% annually. This is below inflation. So, you lost purchasing power, but you survived. And here is the key. In 1982, when inflation broke and Paul Volcker raised rates to 20% when the economy entered recession and everyone was terrified, stocks bottomed. From 1982 to 2000, the S&P returned 17% annually, the largest bull market in history. The investors who held the S&P through the 1970s participated in that boom. They did not get rich in the 1970s, but they positioned themselves for the 1980s and 1990s. 3 positions. T-bills kept adjusting for inflation, preserving capital. Gold exploded 24x during inflation. The S&P survived and positioned for the next bull market. Together, survival through the opposite crisis. Deflation in the 1930s, inflation in the 1970s. Same 3 positions, different mix of performance, but both times survival and eventual prosperity. The 2008 financial crisis, September 2007 to March 2009. This was the second worst financial crisis in history. The entire banking system almost collapsed. Let us see how the 3 positions performed. Position 1, cash and treasury bonds. When Lehman Brothers went bankrupt in September 2008, when AIG was bailed out, when the financial system was hours from complete collapse, cash was the only thing that mattered. Liquidity disappeared. Credit markets froze, but cash worked. Treasury bonds became the ultimate safe haven. The yield on 3-month T-bills went to 0 because everyone was buying them for safety, not return. Warren Buffett held $40 billion in cash entering the crisis. That cash allowed him to make his legendary investments. $5 billion in Goldman Sachs in September 2008, $3 billion in GE, $5 billion in Bank of America in 2011. Those investments made with cash held before the crisis yielded Berkshire Hathaway tens of billions. Cash in a crisis is not about returns, it is about optionality, the ability to act when everyone else is paralyzed. Position 2, gold. Gold started 2008 at $850 per ounce. During the initial crash in September and October 2008, gold fell to $700 as investors liquidated everything for cash. But then the Fed acted with quantitative easing. The Fed printed $1.5 trillion. Gold reversed. Position 3, the S&P 500. The S&P fell 57%. From October 2007 to March 2009. Brutal. Anyone holding stocks lost more than half their wealth on paper. But here is the pattern. If you held through the bottom, the S&P recovered everything by March 2013. 4 years to get back to break even, and then it kept going. From March 2009 to February 2020, the S&P returned 400%, the largest bull market since the 1990s. The investors who held the S&P, who did not sell at the bottom, who reinvested dividends, they created generational wealth. $100,000 invested in 2009 turned into $500,000 by 2020. 3 positions. Cash allowed allocation at the bottom. Gold captured the Fed's inflationary response. The S&P compounded interest for a decade. Together, not just survival, prosperity. COVID 2020, February to March 2020. This was the fastest crash in history. The S&P fell 35% in 3 weeks. Let us see how the 3 positions performed. Position 1, cash and treasury bonds. Cash was again the ultimate asset during the crash. When markets fell 10% in a day, when circuit breakers stopped trading, when everyone was panicking, cash was optionality. Bill Ackman held cash before the crash. He bought $27 million in credit default swaps. These swaps paid $2.6 billion. He immediately allocated that cash into stocks at crash prices: Starbucks, Hilton, Lowe's, Chipotle. all bought at a 40 to 50% discount. Within 4 months, these positions doubled. Cash during the crash allowed the greatest rapid allocation opportunity in modern history. Position 2, gold. Gold started 2020 at $1,050 per ounce. During the initial panic in March, gold fell to $450 as everything was sold for liquidity. But by August 2020, gold hit $2,050, a 42% gain from the lows in 5 months. Then the Fed printed $4 trillion. The government sent stimulus checks. Inflation was coming. Gold anticipated that. Anyone holding gold preserved wealth during the crash and gained wealth during the recovery. Position 3, the S&P 500. The S&P fell from 3,400 in February to 2,200 in March, a 35% crash in 23 trading days. But the recovery was even faster. 3 positions: cash for allocation, gold for the inflationary response, S&P for the recovery. Same pattern compressed into 1 year instead of 10. 2022 bear market, January to October 2022. This was a different crisis. Not a deflationary crash, not an inflationary spiral. A transition, the Fed raising rates to fight inflation. Let us see how the 3 positions performed. Position 1, cash and treasury bonds. This is where position 1 shone. T-bill yields went from 0 in January 2022 to 5% in December 2022. For the first time in 15 years, cash paid a real return. And while stocks fell and long bonds broke, T-bills gained value. If you moved to T-bills in January 2022, you made 5% that year, while the S&P fell 18%, an outperformance of 23%. Cash preserved capital and paid income. Position 2, gold. Gold struggled in 2022. It started the year at 1,800 per ounce and ended at 1,1750, a 3% loss. Why? Because rising interest rates make non-yielding assets like gold less attractive. But gold did not break. It did not fall 50% as long bonds did. It preserved most of its value. And in 2023, gold started rising again, hitting $2,300 in mid-2024. Gold's role in 2022 was not appreciation, it was preservation. Position 3, the S&P 500. The S&P fell 18% in 2022. Growth stocks fell 30 to 70%. Tech stocks were destroyed, but dividend-paying stocks in the S&P held up better. Utilities, healthcare, consumer staples, they fell only 5 to 10%. And in 2023, the S&P roared back, rising 25%. Anyone who held through 2022 captured the 2023 recovery. 3 positions. T-bills paid 5% and preserved capital. Gold preserved wealth without breaking. The S&P fell but recovered quickly. Together, the 3-position portfolio fell perhaps 5% in 2022, while most portfolios fell 20 to 30%. Relative outperformance through diversification, 5 completely different crises. The Great Depression, deflationary collapse. The 1970s, inflationary destruction. 2008, financial system failure. COVID, pandemic and stimulus. 2022, rate shock. 5 different crises. 3 positions survived all of them. Not perfectly, not without volatility, but they survived. And survival plus time equals compounded wealth. Now let me show you why these 3 positions specifically. What makes them special? Why do they work in every crisis? Position 1 is cash and treasury bonds. Why does cash survive every crisis? Cash is optionality. It is the ability to act when others cannot. When markets crash 30, 40, 50%, when assets are on sale, when everyone is forced to sell or frozen in panic, cash allows you to buy. Warren Buffett says his favorite holding period is forever, but his second favorite is cash during a crisis, because cash in a crisis becomes the most valuable asset, not because it appreciates, but because it allows action. Treasury bonds are slightly different. They are cash that pays interest. The yield adjusts to market conditions. When inflation is high, T-bill yields rise. When deflation hits, T-bills preserve value. They are the most liquid and safest asset in the world, guaranteed by the US government, which can print dollars to pay them. This makes T-bills the ultimate defensive position. How much should you have? It depends on your age and risk tolerance. But here is the pattern of the smartest investors. Warren Buffett at Berkshire Hathaway currently holds 30% in cash and T-bills. Ray Dalio recommends 5 to 10% in normal times, 30 to 40% when valuations are extreme. The purpose is not to maximize returns, it is to have dry powder, capital to allocate when opportunities arise, and opportunities arise when markets crash. Position 2 is physical gold. Why does gold survive every crisis? Gold is the only asset with 5,000 years of history as money. Empires rose and fell, currencies were created and destroyed, but gold held value through it all. Why? Because gold has unique properties. It cannot be printed, it cannot be created digitally, it requires physical mining. Supply is limited, demand is constant. When fiat currencies are devalued by money printing, gold appreciates. When financial systems collapse, gold is accepted everywhere. When inflation runs hot, gold preserves purchasing power. The 1970s proved this. Gold went from $35 to $850. The 2000s proved it again. Gold went from $250 in 2001 to $1,900 in 2011. And right now, gold is proving it again. Gold hit $2,700 per ounce in 2024, all-time highs. Why? Because global central banks are buying gold at the fastest rate since 1950. China, Russia, India, Turkey, Poland, all accumulating. They see unsustainable debt, inevitable money printing, and they are diversifying out of dollars into gold. How much should you have? Ray Dalio recommends 5 to 10% of your portfolio in gold, not mining stocks, which are leverage bets, physical gold or gold ETFs like GLD that hold allocated physical gold. The purpose is not speculation, it is insurance. When fiat currencies devalue, when the Fed prints trillions, when debt becomes unsustainable and inflation accelerates, gold protects your purchasing power. Position 3 is the S&P 500 index. Why does the S&P survive every crisis? The S&P 500 is ownership in the 500 largest American companies. Apple, Microsoft, Google, Amazon, Berkshire Hathaway, Johnson & Johnson, Visa, Procter & Gamble. These companies generate profits. They pay dividends. They innovate. They grow. In the long term, the S&P 500 has delivered annual returns of 10% for over a century. Through the Great Depression, World War II, the stagflation of the 1970s, the 2000 tech crash, the 2008 financial crisis, COVID, every crisis, the S&P recovered and reached new highs. Why? Because the S&P represents the American economy, and the American economy has grown for 250 years. Recessions happen, crashes happen, but over time, innovation, productivity, and population growth drive profits upwards, and higher profits drive stock prices upwards. The investors who hold the S&P through crashes, who reinvest dividends, who do not sell in panic, they compound wealth at 10% annually. This doubles your money every 7 years, quadruples every 14 years. In 30 years, a 10% return turns $100,000 into $1.7 million. The key is time horizon. If you need the money in 1 year, do not hold the S&P. It can fall 30% in any given year. But if your horizon is 10, 20, 30 years, the S&P is the best long-term wealth compounding machine ever created. Warren Buffett said that, for most people, the S&P 500 index fund is the best investment they can make. Not picking stocks, not trying to time the market, just owning American businesses for the long term. How much should you have? This depends on age. If you are 30 years old, you can have 80 to 90% in the S&P because you have 30 years to recover from crashes. If you are 60 years old, maybe 40 to 50% because you need more stability. But everyone should have some exposure to the S&P because in Any 15-year period in history, the S&P never delivered a negative return. It always recovers. It always hits new highs. Position 3 is the growth engine that compounds wealth over time. 3 positions: cash for optionality and allocation in crisis, gold for inflation protection and currency devaluation insurance, S&P 500 for long-term growth and compound interest. Together, they create an all-weather portfolio that survives every crisis and compounds through every recovery. Now let me show you what is happening right now in 2025. The smartest investors in the world are positioned in these exact 3 assets, and their positioning tells you everything you need to know about what is coming. Position 1, cash and treasury bonds. Warren Buffett at Berkshire Hathaway is holding $325 billion in cash and T-bills. This is 30% of Berkshire's total assets, the largest cash position in Berkshire's history. Buffett has been selling stocks to raise this cash. He reduced his position in Apple by 50%. He has been selling Bank of America. He is not buying anything. In his 2024 shareholder letter, Buffett said he cannot find anything attractively priced. Translation: everything is overvalued. Stay in cash. Wait for the crash, then allocate. This is the same pattern Buffett followed before every major crash. In 2007, Berkshire had $40 billion in cash. The crash came in 2008. Buffett allocated. Goldman Sachs, Bank of America, GE made billions. In 2019, Berkshire had $120 billion in cash. COVID crashed markets in 2020. Buffett allocated. Now Berkshire has $325 billion. The pattern says the crash is coming and Buffett is ready. Position 2, gold. Global central banks bought over 1,000 tons of gold in 2022, over 1,000 tons in 2023, over 1,000 tons in 2024, 3 straight years of 1,000 plus tons of purchases. This is the largest 3-year total since central banks became net buyers of gold in 2010. China's official gold reserves increased from 1,000 tons to over 2,000 tons. But analysts believe China has much more in unreported reserves. Russia liquidated US Treasury bonds and bought gold. Poland doubled its gold reserves. Singapore, Turkey, India all accumulating. Why? Because they see the same thing billionaire investors see. The US has $36 trillion debt. The Fed will have to print money to manage this debt. Printing money devalues the dollar. Gold protects against this devaluation. These central banks are executing position 2 on a massive scale, and billionaire investors are following. Ray Dalio has 5 to 10% in gold. Paul Tudor Jones disclosed gold positions. Stanley Druckenmiller owns gold. Smart money is in position 2 right now. Position 3, S&P 500. Despite all the concerns about crashes and bear markets, long-term investors are still holding the S&P. Why? Because over time, it always recovers. And right now, the S&P is at 6,000 plus, closer to all-time highs. But here is the key. Long-term investors are not selling. They are holding because they know that trying to time the market is almost impossible. The best strategy is to hold through volatility and buy more during crashes. Warren Buffett has Apple, Coca-Cola, American Express, Bank of America. He is not selling these positions. He is just not buying new ones because valuations are high. But he is holding position 3. Ray Dalio's all-weather fund holds significant exposure to the S&P. Smart money is not abandoning position 3. They are just balancing it with positions 1 and 2. So what should you do? How should you position yourself now in 2025? Here is the actionable allocation based on the pattern. If you are under 40, here is the recommended allocation. 20% in position 1, cash and treasury bonds. This gives you dry powder for when the inevitable crash comes. 10% in position 2, physical gold or gold ETFs. This protects against inflation and currency devaluation. 70% in position 3, S&P 500 index fund. You have time to recover from any crash. You want maximum exposure to long-term growth. If you are 40 to 60 years old, a more balanced allocation, 30% in position 1, cash and T-bills. More protection as you approach retirement, 10% in position 2, gold, same inflation protection, 60% in position 3, S&P 500, still. Substantial exposure to growth, but positioned more defensively. If you are over 60 years old, a conservative allocation, 40% in position 1, cash and T-bills. You need stability. You cannot afford to lose 50% right before retirement. 10% in position 2, gold. Inflation protection remains important. 50% in position 3, S&P 500. Still significant exposure to growth but balanced with safety. These are the 3 position allocations that worked through every crisis. They are not exciting. They do not promise 1,000% returns. They promise survival, preservation, and long-term compound interest. And that is what builds wealth over decades. Here is how to execute this. For position 1, open a brokerage account and buy treasury bonds directly or use a money market fund that invests in T-bills. Current yields are around 4 to 5%. This is real return with zero risk. For position 2, buy physical gold from a reputable dealer or buy GLD, the largest gold ETF or IAU. Ensure it is allocated gold, not paper gold. You want real physical gold backing your position. For position 3, buy SPY or VOO or IVV. These are S&P 500 index ETFs. They track the S&P exactly. Set up automatic monthly purchases, dollar cost. Average into the position. Do not try to time the market, just consistently accumulate. This is not financial advice. I am not a financial advisor. This is pattern recognition based on historical data. You should consult a qualified financial professional before making any investment decisions. But the pattern is undeniable. 5 crises, 3 positions. They survived all of them. 5 completely different crises through 100 years. The Great Depression destroyed stock wealth, but cash and gold survived. The stagflation of the 1970s destroyed bonds, but gold exploded and T-bills adjusted. The 2008 financial crisis broke stocks, but cash allowed allocation, and gold captured the Fed's response. COVID broke everything for 3 weeks. Then stimulus drove the recovery. 2022 killed growth stocks, but T-bills paid 5% and preserved capital. Through it all, 3 positions survived. Cash and treasury bonds for optionality and deflation protection, physical gold for inflation protection and currency devaluation insurance. S&P 500 for long-term growth and compound interest, not 4 positions, not 10 strategies. 3, simple, stress-tested, proven through a century of crises. And right now in 2025, the smartest investors in the world are positioned in these exact 3 assets. Warren Buffett holding $325 billion in cash. Central banks buying 1,000 plus tons of gold annually. Long-term investors holding the S&P despite volatility. The pattern is repeating. The positioning is clear. The only question is whether you will recognize the pattern and position yourself accordingly, or if you will chase returns, hold concentrated bets and panic during the next crisis, losing wealth that you could have preserved. Most people will ignore this. They will believe they can perfectly time the market. They will believe their stock picks will perform better. They will believe the next crash will not affect them, and they will lose 30, 40, 50% when the crash comes. But a small group will see the pattern. They will position themselves in the 3 assets that survive everything. And when the crash comes, they will preserve capital, maintain purchasing power, and have dry powder to allocate at the bottom. Then they will compound interest for the next decade while everyone else is recovering losses. The three positions are not sexy. They are not promising 10x returns next year. They are promising survival through any crisis and compound returns of 10% over decades. This turns $100,000 into $1.7 million in 30 years. This is generational wealth, built through pattern recognition and discipline. If this video showed you a pattern you have never seen before, if you now understand that three simple positions survived every crisis in 100 years, subscribe to this channel because the next crisis is coming. It always is, and when it comes, you will want to be positioned in the three assets that survive everything. Not panicking, not selling at the bottom, surviving and thriving while everyone else learns the pattern the hard way. This is not financial advice. This is pattern recognition, 5 crises, 3 positions, 1 century of proof.